Hi everyone, welcome to Eco Learning Classes. This is Professor Geeta Mahesh. Dear students, today we will be discussing with respect to demand for money. So, what do you mean by demand for money? Here, demand for money is nothing but holding cash in hand. That means always people like to keep cash in their hands. What is the reason why people like to keep cash in their hands? If we consider this, we know that cash is the most liquid form of all assets. By using money, whatever you want, immediately you can buy those goods and services. So because of this reason, people like to keep cash in their hand. To Lord J.M. Keynes, if we consider, demand for money they keep for three purposes. One is transaction motive, precautionary motive, and speculative motive. In our analysis, we combined transaction and precautionary motive as a single or comes under transaction motive itself. And with respect to speculative motive, we will be discussing as a second motive for holding cash in the hands of people. So here, dear students, demand for money as it is the most liquid form of all assets. People demand for money means demand for cash. They want to keep cash in their hands. This we call it as demand for money. According to J.M. Keynes, people liked, that means demand for money means demand for holding money in the form of idle cash. People hold mainly for two motives. One is transaction motive, another one is speculative motive. First, let us discuss transaction demand or transaction motive. We can consider this transaction demand or transaction motive as the principal motive for holding money is to carry out transaction motive. What is the principal motive to hold money in the hands? That is transaction motive. It is a quantity of money that all individuals and firms decide to keep in hand for the purpose of financing their forthcoming expenditure. Every day for one or the other things we need a money, and we usually we keep money to buy the necessaries to run the day or to fulfill the necessaries day-to-day expenses. People like to hold cash in their hand. Take example, we keep cash in our hand to buy the day-to-day expenses like vegetables, fruits, milk. For such type of things, usually we keep money in our hand. That means forthcoming. See, immediately we may need to buy something. For that purpose, we keep cash in our hand, and that we call it as transaction or transaction demand or transaction motive. The main reason, what is the main reason for meeting day-to-day transaction? Because we want to bridge the interval between receiving a salary and our spending. So once in a month we receive money, but throughout the month we will be spending that money. Every day one or the other things we will be buying or we will be spending on one or the other thing. As once we receive a money or salary, and throughout the month we will be spending, so we have to keep cash. Throughout the month we need to buy one or the other, and we have to spend. For that purpose we will be keeping money. So The main reason for meeting day-to-day transaction is to bridge the interval between the receipt of income and expenditure. And this we call it as income motive. And again, to bridge the time of incurring business cost. See, cost of production whenever you run a business. So initially you have to spend, later you'll receive a receipts after the sale of a produced product. So the production will be taking place after finishing the product. You are going to sell that good and then you are going to receive a revenue. So there is a gap between the process of production and earning the revenue, and to bridge this gap, the business firms are going to keep cash in their hand, and that purpose we call it as business motive. You know, dear students, even people like to hold cash in their hand to meet unforeseen, that means emergencies like sickness, accidents, and this we call it as precautionary demand, which is aggregated, added with the transaction demand. Transaction demand for money is mainly determined by the level of income. How much money you keep in your hand always depends on how much income you are earning. There is a positive relationship between your income and transaction demand for money. So this we call it as positive relationship between income and transaction demand for money. Can you write transaction demand for money means the formula you have to write transaction demand for money is equal to f of y. Okay, so there is a direct relationship between these two. As income increases, money in your hand is also going to increase for day-to-day transaction purpose. Now we will be discussing speculative demand for money. What do you mean by speculative demand for money? People, by observing changes in the price of bonds and the rate of interest, they want to take an advantage or they want to earn the benefit from the change in the price of bonds and the rate of interest. So people will keep cash in their hand when there is a low rate of interest. Because if you save, the rate of interest what you are earning is very less. When rate of interest is more, you will sacrifice other entertainment, other enjoyments with that money. Because the rate of interest what they offer is more than what you are going to enjoy with that money. So in that situation, you are going to make a deposit with a bank. So you keep money for taking advantages of this or to earn higher rate of interest or to get a benefit from the changes in the prices of bonds. Then that purpose we call it as speculative demand for money. Here you can see it is a speculation about future changes in the rate of interest and bond prices that are resulting demand for money is called speculative demand for money. So people will keep cash in their hand because they want to take a advantage or benefit from changes in the rate of interest and bond price. According to J.M. Keynes, people compare the rate of interest on savings deposits and rate of returns on bonds to make an investment. And moreover, we know that there is an inverse negative relationship between the rate of interest and bond price. So when rate of interest is very less, at that time bond prices will be more, and when bond price increases, we have to sell bonds if we have invested on bonds. When the prices are more, you sell and convert into money. After converting into money, you have to keep that money in hand. So what happens? Cash in hand is going to increase. When bond price is more, that means rate of interest is less. Clear, dear students? That is what here they're saying. Bond price and rate of interest inversely related. If rate of interest is low, people expect. That means people will expect it will rise in future, anticipating capital loss from the bond holding. That means when the rate of interest is low, they expect that in future, if rate of interest increases, then definitely there is an inverse relation. No, definitely bond prices will decrease. And when bond prices will decrease, if you have invested on bonds, you are going to incur loss. So because of that reason, people will not sell bonds when the prices are less. They will sell when bond price is more and they will convert into cash. When bond prices falls, no, that time rate of interest is going to increase. Clear? Then they are going to make a investment where they will get a more benefit. There they are going to make a investment. Okay. So that is what here they are saying. If rate of interest is low, people expect it to rise in the future, anticipating the capital loss from bond holding. Now what they will do? People will hold more cash because they will sell at a high price and they are now the bond price is more. No, now they will sell and they will convert into cash and they will keep and they avoid a capital loss. So there is an inverse relationship between speculative demand for money and the rate of interest. IE means here rate of interest. When rate of interest is more, then the cash in the hands of people will be less. Already they will invest because they are getting a high rate of interest. When the rate of interest is less, then definitely they will sell bonds and they will keep cash in their hand. So money in the hands of people will be more. So because of that reason, we say there is an inverse relationship between rate of interest and speculative demand for money. Here with respect to bonds, you can see here, dear students, the face value of bond is 100 rupees. Now, if you consider present value, if the price of bond is 90, then when you return, you may get a 100 rupees. That means the earning is the rate of interest that you are going to earn is 10%. So there is a low rate of interest and a high bond price. In future, if you think that the rate of interest is going to increase by 40%, that means the price of bonds are going to decrease. So to avoid this capital loss, the value of bonds what you are holding is 90 rupees. Now, if it is becomes a 60 rupees, then the value of your bonds are decreasing. No, now what they will do at present situation itself, they are going to sell as the bond price is more. They will sell and they will keep cash in their hand. When the bond price falls, that means rate of interest is more, no? That time again people will make an investment on these bonds. When price is less, they will buy those bonds. When price increases, that time they will sell and they will keep cash in their hand. It means when just see this off of this, when the rate of interest is less, that time they will hold money in their hand, more money in their hand. When the rate of interest is high, they will hold less money. Why they will hold less money means the money what they had will be invested. What they had will be invested on bonds because the price of bonds were very less when the rate of interest is more, and when they buy bonds at lower price, then they can have high rate of interest. Liquidity trap. It is a situation of very low rate of interest. So people expect the rate of interest to rise in the future. Consequently, the bond prices to fall. So it becomes totally unattractive to make invest money on or in bonds, causing capital loss. Now bond price is more. In future, already you invested and the bond price is more and your bond price is going to fall in future. Definitely what you are going to do, you are going to sell because to avoid capital loss. So people hold more cash, okay, but when the rate of interest is less and bond price of bonds are more, that time they will sell and they will keep cash in their hand and they have nothing to make investment. The rate of interest is so low where people have money but nothing to invest. They have money in their hand, but for investment nothing, they don't have anything. So that situation we call it as liquidity trap. Okay, speculative demand for money is infinity, making demand curve a horizontal straight line. See here at the point of L, it becomes, this becomes horizontal, it is equal to infinity. We have huge funds, we have huge funds in our hand, but for investment, we have nothing, nothing to invest. That situation we call it as liquidity trap. Very low rate of interest. See, when rate of interest is more, money in our hand is zero. When rate of interest falls, money in our hand is keep on increasing, you can see. And this is very minimum, very low rate of interest. At that time, you can see it becomes money in hand is infinity. We have countless amount in our hand. But for investment, nothing. That situation we call it as liquidity trap. Dear students, if you like, please like, share and subscribe to my channel. Thank you so much.